Welcome to the Deep Dive, your shortcut to being truly well-informed. We unpack the most important nuggets of knowledge and insight from stacks of sources so you can quickly grasp what's really happening. Today we're doing a special TalkTickers Deep Dive. We're cutting through the noise from Chevron's second quarter 2025 earnings call, which just wrapped up today, August 1st.
Right, just finished.
Our mission is simple: give you the clearest, most concise breakdown, the numbers, management strategy, and crucially, how the market reacted right away.
Absolutely. Think of us as your guides through the jargon and the details. We want you to walk away really understanding the key takeaways, especially if you track the energy sector.
Okay, so let's kick things off, the raw numbers. What was the headline story for Chevron this quarter?
Well, on paper, it looked pretty strong. Their standard earnings per share, the GAAP EPS, that landed at $1.45, just nudged past the $1.43 consensus.
Okay, so a slight beat there.
Yeah, but the adjusted EPS, the number that strips out the one-off items to show core performance, that was a much stronger beat, came in at $1.77, surpassing the $1.70 consensus by a solid 4%.
Right. That adjusted number often tells a clearer story. And it wasn't just earnings per share, was it? Were other metrics strong too?
Oh, definitely. Revenue hit $44.82 billion. That beat the $44.0 billion consensus, though it is worth noting it was down about 12.4% compared to last year.
Okay. A drop year over year.
But the operational side, really remarkable. Production reached a new company record, 3.4 million barrels of oil equivalent per day. That's up 3% year over year.
A new record. Wow.
And here's a big one. The Permian Basin hit a huge milestone, 1 million barrels of oil equivalent per day. That's a target they've been working towards for years.
1 million barrels a day just from the Permian. That is a massive operational win. And what about the cash flow? I heard that was impressive.
Yeah, very impressive. Free cash flow surged. Really jumped by 113% year over year to $4.9 billion.
113%. Okay.
And at the same time, they kept spending disciplined. Capital expenditures were actually down 7.5% year over year to $3.4 billion.
Spending down, cash flow way up, and shareholder returns.
Still strong.
Still very robust. $5.5 billion returned to shareholders this quarter. That breaks down to $2.9 billion in dividends, $2.6 billion in buybacks. And get this, it's the 13th quarter in a row they've returned over $5 billion.
13 consecutive quarters. Okay, yeah. So undeniably strong operational performance, solid financials, record production, great cash flow.
Right, ticks a lot of boxes.
So here's the puzzle then. Despite all these, seemingly great results, the market's immediate reaction was, well, pretty muted. The share price ticked up a bit before the call, maybe slightly after, but it ended the day slightly down.
Yeah, flat to slightly down.
Why do you think investors are being so cautious here? What does that tell us?
It's a really critical point, actually, not just for Chevron, but for the whole sector. This muted reaction. It suggests that even really strong company-specific news, like Chevron's record production, can get overshadowed by bigger worries. Macro fears, you mean?
Exactly. Commodity price worries are still hanging around. Brent crude prices are down, 11% year over year? That seems to be weighing on sentiment more heavily than Chevron's individual wins. So for you, the listener, it just highlights that constant tension, right, between how one company is doing versus how the overall market feels.
That's a great insight. So, okay, given that challenging backdrop, how does Chevron manage these numbers? Let's dig into their capital discipline a bit more. Adjusted earnings were $3.1 billion. I saw mentions of special items impacting that. Can you unpack those?
Sure. There were a few things affecting the JAP number. You had fair value measurements, some pension costs, asset sales. Altogether, they resulted in a net charge of about $215 million. And foreign currency swings also hit earnings by about $348 million.
Okay.
But the really interesting part on spending, their organic capital expenditure, the money spent on their core projects, was $3.5 billion. Management made a point of saying that's the lowest quarterly total since 2023.
Lowest since 2023, even while delivering record production.
Exactly. They also spent an extra $200 million on inorganic stuff, mostly buying up lithium acreage. That's a little hint towards their future diversification strategy.
Right, lithium. We'll come back to that. The cash flow story, $8.3 billion from operations, excluding working capital. Adjusted free cash flow up 15% just from last quarter to $4.9 billion. And this happened even with crude prices falling 10% in the quarter.
It really does speak volumes about their efficiency, doesn't it? Yes, adjusted earnings were down quarter on quarter. That was mainly because they got lower prices for their oil and gas, the upstream side, plus higher depreciation, some tax impacts.
But something offset that.
Yeah, partially. They saw better refining margins and higher volumes in their downstream business, selling gasoline and other products. And looking ahead, management sounds pretty confident. They expect full-year production growth to be near the top end of their 6-8% guidance range. That's excluding Hess, by the way.
Okay, good context. So let's shift gears a bit. Beyond just the numbers, this quarter really spotlights some huge strategic moves. Top of the list has to be the Hess acquisition, right?
Yeah.
Closed just 2 weeks before the call.
Absolutely massive. A $55 billion deal gets Chevron a 30% stake in Guyana's Stabroek Block. That's widely seen as, one of the best oil discoveries in ages, super low production cost.
A game changer, potentially. And what did management say about integrating Hess?
This was a key highlight. They were very clear. The synergies, the cost savings, and efficiencies from combining, they expect to hit the full run rate by the end of this year.
By year end? I thought the original guidance was longer than that.
It was 6 months faster than they initially guided. That's huge. It means the deal should start adding to Chevron's earnings per share, becoming cash flow creative, as they say, in the fourth quarter already.
Wow.
And another sign of confidence. They've already bought back more than half the shares they issued to pay for Hess, shows strong belief in the deal's value.
6 months faster on integration for a deal that size.
Yeah.
That is incredibly fast. What does that signal about their execution capability? Any risks with moving that quickly?
It signals immense focus, that's for sure. They've clearly thrown significant resources at making this work smoothly and quickly. The risk is always that you miss something when you rush. But Chevron generally has a pretty good track record with integrations. Pulling this forward is definitely a bold statement about their confidence.
Okay. And sticking with big achievements, that Permian milestone.
Yeah.
1 million barrels a day. They set that target over 5 years ago, right? And they hit it.
Right on schedule. And the conversation now isn't just about more barrels from the Permian, it's shifting.
Shifting how?
Towards, moderating the spending there.
Right.
Reducing the capital investment and focusing on generating more free cash flow from that already strong position. They expect Permian capital spending to be at the lower end of the $4.55 billion range for 2025.
So less spending next year.
And dropping further in 2026. The aim is to pull an additional $2 billion in free cash flow out of the Permian next year. It's a pivot, from flat-out growth to optimizing value.
Smarter barrels, not just more barrels. Makes sense. And beyond Hess and the Permian, what of the rest of the portfolio?
Generally strong performance across the board. Base assets are doing well. The big Tengiz project in Kazakhstan, the Future Growth Project, or FGP, is producing at full rates. Gulf of Mexico projects are ramping up nicely.
And refining?
Yeah, another record there, actually. Highest U.S. refinery crude throughput in over 20 years.
Yeah.
And that's despite having fewer refineries than they used to.
How do they manage that kind of efficiency gain?
It seems to come down to really consistent top-tier performance when they do maintenance turnarounds on their big facilities. They're just getting more out of the assets they have. Production efficiency for the whole company is up 1-2% so far this year.
Okay.
And a lot of this operational excellence seems tied to this big internal restructuring they've done.
Ah, yes, the organizational transformation. Reducing reporting units by 70%. That sounds like a huge shakeup.
It is, 70%. The idea is to group similar businesses together globally, making it faster to show best practices, standardize processes, cut out duplication.
And does that actually save money? How does shuffling boxes on an org chart translate to billions?
Well, they expect it to drive $2-3 billion in structural cost reductions by the end of 2026. It's about removing layers, speeding up decisions, making the whole company more agile, and ultimately more efficient. Cutting bureaucracy, basically.
$2-3 billion. That's significant. Something else that caught my eye was the renewed focus on exploration. Management kind of admitted they hadn't done great there in the past.
Yeah, they were pretty frank about past underperformance.
But now they're looking at both mature areas near existing pipes and also riskier frontier areas. Suriname, Namibia, Egypt.
Right. They're opening the aperture, as they put it. It sounds like a more targeted approach this time, leveraging their global presence and presumably better geological data. It's still a risk, exploration always is, but it could be crucial for replacing reserves long term.
And it's not just oil and gas exploration, is it?
No, exactly. That lithium acreage acquisition in Texas and Arkansas, that's clearly a first step towards building a U.S. lithium business. And they're also expanding pilot projects for carbon capture and storage, CCS. So it points to, a balanced long-term strategy, core business plus future energy tech.
Okay, let's turn to forward guidance then.
Yeah.
What signals did management send about the future? They raised the 2026 free cash flow target.
They did. Bumped it up to $12.5 billion. That shows a lot of confidence, right? High conviction they can deliver.
Definitely. And buybacks.
The range stays the same, $10-20 billion annually. Management stressed they're balancing that with funding growth and keeping the balance sheet strong. They did flag a slight dip in production for Q3, about 60,000 barrels a day, due to planned maintenance. Just a temporary thing. But overall, it reinforces that message they keep hitting. Returns first, transition ready. No change to how much they plan to spend on the energy transition side either.
Right. So we've laid out all these strong points. Record production, surging cash flow, faster Hess integration, cost cuts.
Yeah.
Which brings us back to that disconnect with the market reaction.
Exactly. It's the core tension here. You've got management painting a very positive picture, backed by solid execution. And then you have the market sort of shrugging its shoulders, remaining guarded.
Because of those oil price worries we talked about.
That seems to be the main driver. Investors appear to want confirmation of a tailwind from higher commodity prices before they really reward the stock. Even though Chevron is using its scale, its discipline, that Guyana exposure, to navigate these lower margins better than many peers.
So, despite the market's hesitation, Chevron's actual performance relative to its peers has been good.
Yeah, significantly better, actually. If you look at total return, Chevron stock is up, 8% this quarter, 7% year to date?
Yeah.
That's quite a bit better than the main energy sector ETF, the XLE, over those periods.
Okay.
So it suggests the story is shifting. It's less about a company fixing itself and more about a company executing well with advantaged assets like Guyana and the Permian and turning that into a cash return machine.
Interesting. So for you, the listener, what are the key things to watch going forward? What are the catalysts?
Number one is probably the Investor Day, November 12th in New York City. That's going to be critical. Expect more details on Hess synergies, capital allocation plans, buybacks. It's a big one.
Right. Investor Day. What else?
Well, you'll want to see if that Q3 production dip from maintenance is just temporary as guided. Obviously, any big moves by OPEC Plus on production quotas could shake things up for oil prices.
Mm-hmm.
And then on the newer stuff, keep an eye on permitting for those U.S. CCS hubs they're working on and whether they finalize that lithium joint venture they mentioned. The options market is already pricing in a pretty big move, like plus minus 6% around that November Investor Day. So yeah, expectations are high for news then.
So the outlook seems to hinge on execution versus commodity prices.
Pretty much. If management keeps delivering this record output, integrates Hess smoothly without costs ballooning, then the stock could definitely regain its historical premium valuation compared to the sector. But if Brent stays stuck below $70 for a long time, or if they stumble on the Hess integration, that would obviously challenge the positive story. It's that classic fundamentals versus market sentiment battle.
Fascinating dynamic. Okay, and now it's time for our not financial advice segment.
And let me just jump in with the important disclaimer. This part is purely for informational and entertainment purposes. It is not financial advice. Investing involves risk. Always do your own research and consult with a qualified financial professional before making any decisions.
Absolutely. Okay, disclaimer delivered. So, considering everything we've discussed, Chevron's strong execution, management's confidence, the boost from Hess, all happening while the market seems a bit skeptical, here's an outrageous but maybe plausible trade idea.
Okay, let's hear it.
The pitch. Long Chevron. Short an energy ETF basket.
A pair trade. Betting on Chevron to outperform its peers.
Exactly. The idea is you initiate a long position in Chevron stock. At the same time, you take a short position in a basket of other big energy companies, maybe using an ETF like XLE as a proxy.
So the thesis is?
The thesis is that Chevron's specific strengths, that capital discipline, the superfast Hess integration boosting cash flow, the shift to getting cash from advantaged assets like Guyana and the Permian will let it keep outperforming the rest of the sector, even if oil prices themselves stay kind of flat or choppy.
Right. You're betting on company execution winning out over general market or commodity headwinds. Capitalizing on the market, maybe not fully appreciating Chevron's specific advantages right now.
Precisely. And that November Investor Day acts as a potential near-term catalyst for the market to perhaps reevaluate and recognize that outperformance.
Yeah.
You're essentially picking what you think is the best house on a potentially shaky block.
Interesting. A bet on relative strength.
Okay, so just to recap our deep dive today, Chevron put up a strong operational quarter. Record production, Big jump in free cash flow, all driven by disciplined spending and getting that Hess deal integrated quickly.
Yeah, the company is clearly pivoting, using its scale, its efficiency to generate sustainable free cash flow and deliver strong shareholder returns, even when the energy market is, let's say, volatile.
The key takeaway for you, our listener, is really thinking about how a company's solid performance and clear strategy can sometimes diverge from what the market is doing in the short term. And maybe what opportunities that kind of disconnect could present for your own thinking.
Definitely. We'd encourage you to keep a close eye on those Investor Day updates coming in November, and always consider how the bigger picture, the commodity prices, might interact with Chevron's specific advantage portfolio.
Thank you for joining us on this deep dive.